Today I'm joined with a panel of my colleagues from the various Ray White Group businesses.
Hi, my name's Jeff Moxham. I'm the principal of Ray White Commercial Metropolitan Sydney.
Hi, I'm Stephen Pajoukis, Executive Director at White & Partners. We provide capital and boutiques advisory services for real estate investors and developers.
Hi, I'm Peter Wilshire, partner from Ray White Valuations, head up the residential and mixed-use development division.
Hi, I'm Eddie Mansour. I'm a partner at Ray White Projects.
Hi, my name is Vanessa Rader. I'm the Head of Research for Ray White Commercial. The stimulus is really going to make a massive impact to this market. We've got the developers out there actively looking to pursue these investments, but what about financing? Interest rates are at their all-time low, but does that really mean that financing is available? Isn't it easy to get? So what are you seeing in your business?
Vanessa, I think that's it's an interesting question. We get that question from a lot of our clients, and so following the Royal Commission, the bank's appetite has really narrowed in. However, there's been an emergence of alternative lenders, and there's a broad spectrum of these types of lenders. And don't get me wrong, the banks are still there, and they're still a large source of funding for the real estate sector. But we've got your non-banks, which includes people like the US and UK life insurance companies. You've got some Japanese insurance companies out here also. You've got private groups such as ourselves that are providing capital into the market, and then you've got your family offices as well. So it's quite a broad spectrum, and it's probably providing the stimulus that Jeff's talking about in terms of development site sales, where you can still actually get funding for sites if you take the right approach and find the right lender that suits your project and that type of property.
Okay, so it's a bit more kind of strategic in the way that you do things now, rather than just kind of knock on the door of the bank, just looking for the different options in the different places, and that's something.
Absolutely, yeah. So we provide funding from our own balance sheet, from the family office. We even know when we're not providing through our balance sheet, we'll be very strategic about the respective banker that we'll approach or the respective funder. Each funder has a certain type of appetite. And we know what kind of property they want to finance and the flexibility they'll provide to match the borrower's requirements.
So I suppose you're seeing a lot of this, Peter, because the banks are typically who your client is, and you're being appointed to do valuations on behalf of the banks. Are you seeing this change in who's appointing you to do these valuations? Are we getting more of these second-tier lenders, if you like, appointing you for valuations?
Certainly seeing historically the majority of the construction funding valuations have been for the major banks in the last sort of 3 to 5 years, and especially in the last sort of 12, 18 months, there's been a substantial increase in non-bank lender space for construction reports that we're doing.
So Eddie, you're really dealing with the end users when it comes to financing. So in your projects, are you seeing any of this same thing going on, or are you finding that they're going to your traditional banks, taking advantage of some of the really good deals that are actually on offer at the moment for some of our banks?
It's a great valid question, Vanessa. We're certainly seeing that traditionally. A lot of buyers have been going to the traditional banks, but through brokers and uses of companies like Loan Market that the families are part of. They've actually been looking at different institutions, different lenders. There are banks and institutions that I'd never actually heard of that have sort of come to light during this COVID period. So it's the appetite of that lender and the ability to meet criteria. St George have been offering $1 mortgage insurance loans, which has opened it up to a variety of people that are looking in different areas.
So we know that the government's been quite forthright with providing stimulus during this time, and the home builder is one of the ones that you're probably seeing quite a lot of, so it's really stimulating the construction industry and making sure things are happening. Are you seeing much take-up of that?
So the great thing about our business is we've got a wide variety of different specialists across the group. Certainly when the home builders scheme was announced, we noticed out in the northwest, west and southwest pockets that land was receiving a great uptake. We also had buyers who were looking for apartments that were just starting, so the stimulus allowed a 3-month gap for a construction to be started, so that allowed that to come through as well. What we have now seen with the new stimulus, the recent one that the government, the New South Wales government announced around stamp duty, is rather than having that focus around that cheaper end stock up to $550 to $650, allowing stamp duty concessions now up to $800,000 and prorated to $1 million, has widened that net for a lot of buyers, especially first home buyers looking around your northern suburbs now rather than traditionally having to go out towards those outer suburbs in. So it's exciting to see that going on. areas like the Sutherland Shire, for example, have had a bit of a resurgence of new apartment stock coming into those under that scheme.
Okay guys, it's great to have you here today. Really appreciate your time and giving us your insights on what's going on in the market in the residential development space. So thanks very much. And we look forward to sharing our insights with you in our next video. Thank you.